Airbnb stock has fallen 13% this month, taking the stock down to $132 a share. At that price, the company has a market cap of $85.6 billion. It's got $10.3 billion of cash and investments and $2 billion of long-term debt, so the enterprise value is $77.3 billion. Revenue over the last 12 months has grown by 23% to $9.1 billion, and net income has increased by 41% to $2.3 billion. The company has also reported $3.9 billion of free cash flow, so Airbnb is operating with a gross margin of 82% and a free cash flow margin of 43%. These are impressive financials, and they explain why the stock is expensive at 37 times earnings or 20 times free cash flow. Airbnb is a company that IPO'd during the worst period for travel in 100 years. The company had to adapt, and a series of cost-cutting measures has made it a much leaner business. Today, more than 90% of Airbnb traffic is direct or unpaid, meaning Airbnb doesn't need to spend much on marketing. A great example is the Airbnb Barbie house, which generated a ton of free coverage, more than 250 million social media impressions. But as Airbnb has grown, some cracks have appeared. Customers complain of hidden fees and fussy hosts. Local groups believe that too many Airbnbs in an area harm communities. Perhaps most important, average daily rates have increased, making Airbnb not as affordable as it once was. To be fair, Airbnb is aware of this, which is why their recent platform upgrade includes features that make it easier to find cheap rooms. And Airbnb still has plenty of growth ahead. The company has lots of room to expand in Asia, with Japan and Korea being a key focus. The business can earn more from experiences, and there's potential for paid advertising on the platform. Right now, for every dollar spent on Airbnb, $10 are spent on hotels. This implies plenty of room for Airbnb to take market share, and longer-term stays offer another route to cash generation. Airbnb's cash pile is a key pillar of the investment case. The company earned almost $200 million in interest income on its cash in the latest quarter alone. Let's assume that Airbnb grows 20% this year and then 15% for the following 4 years. That would put revenue at roughly $20 billion in 5 years' time, and a net income margin of 25% puts earnings at $5 billion. With its financial strength, I think it could manage a 30 times multiple, which would put the valuation at $150 billion in 5 years' time. That works out to an investment return of 11.9% a year. That's not much margin of safety, and those returns would be higher if it wasn't for significant stock-based compensation. Even so, this is a quality business, and I rate the stock a solid buy, but these are my personal opinions, not financial advice, and I do hold shares in Airbnb. For more detailed investing ideas, make sure to visit our website, overlookedalpha.com.